Thank you, everybody, for attending. I will go ahead and open up the Budget and Finance Committee for January 4th, 2014. We do not have a quorum at this time, so we will start off with hearing December 4th, excuse me, December 4th for the minutes. I'm thinking ahead.
We're 11 months behind, whichever it is.
Welcome for all that are in attendance. We will not be able to vote on anything at this time until we get our full quorum of our committee members. But in the meantime, we will go forward and hear a presentation, a comprehensive presentation of our annual report, financial report from Crossland and Associate. Eric,
this is our annual comprehensive annual financial report. Our auditors are here to present it to you. Dan Miller will, I think, be the lead in presenting it. He was the lead principal in the audit process. We go through this every year and present this to the board, and our efforts to be fully transparent about how we operate, and want to give them the floor to present that to you tonight. The Finance Committee does serve as the Audit Committee as well. So all that we ask that you do is hear the presentation tonight and then advance it to the board for acceptance at the December 9th meeting next Tuesday. So, Dan, take it away.
Thank you.
And we have both the annual report for the city overall and the conference center here.
Yes, you should have 4 items in front of you. Two results books, results on the audit, and then 2 financial statements. And I'm going to start with the one that's the results of the City of Franklin audit, the one with the lamppost on the front.
Okay.
And the very first page is an introductory letter stating that a direct line of communication between our firm and the board, and particularly this committee, is essential to an effective audit. So we appreciate being here and the opportunity to meet with you. We also encourage that at any time during the year, if you have any information for us or any questions, please always contact us. This letter also expresses our appreciation to the entire city team, particularly the finance department, for all of their hard work. Russ and Mike and others who work diligently throughout the audit process. On page 2 starts the report on the results of the audit. We have completed our audit of the city's financial statements. We have drafted our unmodified opinion, and that opinion states that the financial statements are fairly presented in all material respects in accordance with U.S. accounting principles. As you'll see there at the top of page 2, the state of Tennessee does have oversight responsibility for our audit, and they approved our audit engagement through the comptroller's standard contract to audit. We confirm in the middle of the page that we are independent accountants with respect to the city and the performance of all of our services under the requirements of the American Institute of Certified Public Accountants, and also under government auditing standards. You can see at the bottom of page 2 the engagement personnel. Again, I served as first principal, and Dell Crossland, the firm's managing principal, served as the concurring reviewer on the engagement. On page 3, our responsibility under U.S. auditing standards is to obtain reasonable assurance about the fair presentation of the city's financial statements. So we obtain reasonable assurance. To obtain absolute assurance would require us to test every single transaction, and obviously that's not practical. And so we are doing things on a test basis and obtain reasonable assurance. We also consider and test certain elements of the city's internal control as a basis for designing and planning our audit, but not necessarily for the purpose of giving an opinion on your internal control. And so we don't give a separate opinion on those controls, but we have considered them in planning the audit. On page 4, management is responsible for making significant judgments and estimates in preparing the financial statements, and those are listed there. On page 4, some of the more significant ones would be useful lives and valuation of capital assets. Of course, capital assets are the largest balance on the city's financial statements. They're about over 80% of total assets are comprised of those capital assets. The valuation of donated capital assets, including the streets, and also contributed capital for the water and sewer department. Appropriateness of the assumptions used in the pension and OPEB, or the post-employment benefits obligations that we'll talk about in the financial statements. Those, again, are significant judgments and estimates. And then finally, the valuation of investments for the fiduciary pension fund. There's a number of investments in that fund that are not traded on a exchange market. And so the valuation, how we record those in the financials, is based on a number of judgments and estimates that ultimately management makes with the consultation of investment advisors. On page 5, we confirm that there were no unrecorded entries, no past entries. All adjustments identified during the audit have been recorded in the financial statements. Management is also responsible for the selection and use of appropriate accounting policies. And those are described in Note 1 to the financial statements. During our audit, we, of course, look at those accounting policies. We believe that they are appropriate and reasonable, and also comprehensive under U.S. Generally accepted accounting principles.
Excuse me.
Yes.
When you say reasonable, do you ever get questioned about that term?
In what context?
In relation to the correctness of all of this. I mean, when you say reasonable, would anybody question, when you say you can't
Yes.
be absolutely sure?
Yeah.
Yes. Well, as one example, we talked about the reasonableness of the assumptions used for capital assets.
Yeah.
So capital assets are set to depreciate over a certain period of time. We look at how reasonable that depreciation period is. If you're depreciating a building over 150 years, that's probably not reasonable. A life of 40 to 50 years would be reasonable. So that's just one example.
Somebody might use 35.
So you don't consider that a problem at all, to use the term reasonable?
No.
Okay,
No.
all right. I don't want to, I don't want to jaywalk, but, I birdwalk, but I am concerned about that word. That's your opinion that it's reasonable,
Correct.
and everybody accepts that.
Correct.
That's good, okay.
Yes, that's a good question. Continuing on page 6, we did not note any instances in which management obtained a second opinion or consulted with another accounting firm regarding accounting or financial reporting matters. We had no disagreements with management during the course of the work, and we encountered no significant difficulties. We did not identify any fraudulent or illegal activities material to the financial statements, and nor were any such items disclosed to us by management. On page 7, we have read and considered the supplementary and other information in the city's CAFR, Comprehensive Annual Financial Report. We noted no material inconsistencies or misstatements of fact in that other information. And then based on our planning procedures and risk assessment, the areas of audit emphasis are listed there at the bottom of page 7. Some of the more significant ones, of course, would be cash and investments, which we confirmed. Receivables and long-term debt, we also confirmed the majority of those. Revenues, including property taxes, sales taxes, grant revenues, water and sewer revenues, we looked at all of those during the course of the audit. Salaries and benefits, convention center, conference center activities, and then we'll talk about the implementation of some new GASB standards that are coming up for fiscal 2015. Probably one of the most significant ones would be capital assets, including the street acceptances. You'll see in the financial statements, additions to capital assets this year were about 32 million. And then donations and contributions of capital assets were about another 32 million. So you've got nearly $65 million of additions to capital this year. On page 8, we, in addition to the financial statement audit, we also conducted an audit of the city's compliance with its federal grant programs. And the city spent $1.1 million in federal program dollars this year. We tested one major program, and we have drafted an unmodified opinion stating that the city complied in all material respects with that grant program. And then on the bottom of page 8 and continued on page 9 is a discussion of some pretty significant recent accounting pronouncements that are again going to impact the city for fiscal 2015. These are GASB statements 67, 68, and 71. And all three of them relate to the city's pension plan and pension obligation. 67 is going to require some significant new disclosures in the financial statements about the pension plan. There's going to be new disclosures next year about the pension plan's investments, the things that the plan is investing in, how the allocation is determined, the composition of the pension board, how the pension policies are changed. There's just a wide variety of disclosures. There's going to be new information about the discount rate, and then also new information about the how the pension plan obligation is calculated by the actuary. So we recently issued a report under these new standards, and it added about 5 pages to the report. So there's going to be a lot of information included. And then GASB's statements 68 and 71 is going to take the information that's been calculated under that first statement, 67, and is going to require the city to actually record the full pension plan liability. So right now, you'll see in the financial statements under the old standards, the city has about a $12 million asset, because under the old standards, the city has put more money in than was required to for the pension plan. Under the new accounting, it's saying you still look at the entire unfunded obligation, which is about $3 to $5 million right now. You've got to put that unfunded obligation on the financials. So the city will go from a $12 million asset to a $3 or $5 million liability, and all that will happen next year through a restatement of the net position.
We're not worried about that, are we?
Well, you're disclosing, Russ, you had mentioned this to us before. We're disclosing everything, and it's out.
Correct. And I'll point out several places in the report where there's information about this for you all to look at. But obviously, pretty significant item coming up. On the bottom of page 9, material written communications, there is the management representation letter that we've included really for your informational purposes, so you can see the types of information that we're asking for during the audit and what management is representing to us in connection with the audit. Are there any questions on that before we get into the actual financials? All right, we'll get into the actual CAFR now, which is the booklet that looks like this with the cannon on the front.
We're very proud of our cannon.
It's
That's a good picture.
and just past the table of contents is the introductory section, and this section contains the letter of transmittal. Also, the GFOA certificate on last year's CAFR, the 2013 CAFR. And I will take a moment to point out that the course, the GFOA reviews the CAFR every year and gives the city this award. But the review last year was very positive. There were only 2 comments on the whole report. And so just wanted to point that out, that it was a very good review. And then thirdly, there's information about the city's organizational chart and also the elected officials. And then starting in the financial section, on pages 1 and 2 is the independent auditor's report. And of course, this report explains to the reader that management is responsible for the financial statements, that
Wait,
we are,
wait just a second. Where
Yes.
are you?
the independent auditor's report.
Okay, got
Yeah.
it, got it.
Yep. And then it explains, of course, our responsibility for performing the audit, and it explains the information that we're giving an opinion on and the information that we're not. Generally, we give an opinion on the basic financial statements and notes, and then we do not give an opinion on the beginning, the introductory section, or the statistical section in the back. On page 3 starts management's discussion and analysis of the current year activities and the comparison of those activities to 2013. It's very well written and very detailed. And then continuing on to pages 12 and 13 is the government-wide statement of net position.
13?
12 and 13. And you can see at the bottom of page 12, 3 or 4 lines up from the bottom, total assets were $866 million at the end of 2014. That compares to $811 million at the end of 2013. The majority of that increase, again, relates to capital assets. Total capital assets increased about $52 million and totaled $760 million at the end of the fiscal year. On page 13 in the middle, you can see total liabilities of $203.7 million. That compares to $196 million last year. And most of the change, that increase of about $8 million, is due primarily to the debt activity. Of course, there was issuance of new debt, $7 million for general obligation capital improvement bonds, and then $10 million for the pension bonds. And the issuance of new debt was offset by debt repayments of about $10 million during the year as well. So the very last line item, total net position, $651,000. That is an increase, $651 million, thank you. It's an increase of $46 million from last year.
46 increase.
Yes, and the details of that increase are on the very next page, page 14, which is the statement of activities. And you can see that change 3 lines up from the bottom. Change in net position, total of $46 million. 34 of that relating to governmental activities, and about $11.7 million relating to the water and sewer business type activities. Total governmental revenues were about $68.6 million. That's nearly $2 million more than the revenues last year. Most of that increase relates to increases in sales tax revenue, which was up again this year by about $1.2 million. Sales taxes were totaled $27.2 million for the year. And then on the water and sewer side, revenues were up about 4%. Expenses were up 3.2%. And the water and sewer had very strong capital contributions this year of about $11.2 million.
Have you changed pages?
That's on page 14.
Okay.
Any questions before we move on to 15 and 16? On 15 is the balance sheet of the governmental funds. And you can see in the very left-hand column, the general fund, which had total fund balance of $32.7 million at the end of 2014. And that was an increase of about $3.8 million
How
from
much?
last year. 3.8, yes. And the increase in the general fund balance was really a combination of, one item was in lieu of parkland funds, which was about $2.3 million. And then the other item was positive budget to actual variances in pretty much all the city departments. There was cost containment measures remain in effect, and so positive budget to actual variances caused increase in the general fund balance. You can see the second column, multipurpose capital project fund, is the only fund at year end with a negative fund balance, and that was planned. And it was caused by capital expenditures in advance of reimbursement through issuance of debt. And so in 2015, the city plans on issuing debt, which will cause that fund balance to be positive. And it's important to note that there was one fund last year with a deficit, the Road Impact Fee Fund, that is now out of deficit this year. There was some strong fees collected in that fund this year, and also a very small transfer, about $63,000 out of the general fund to get that fund to even at the end of the year.
Do we anticipate that next time? A
I
transfer?
didn't know we did that.
We'll see.
Okay, okay. Well,
Yeah, you did a couple transactions at the end of the year in terms of transfers to make sure that we were not in any deficit positions. But yeah, we made significant progress in the road impact fee from where we were
Okay,
just a
I'm
year
glad.
ago, 2 years ago,
Yeah.
et cetera. So
And that'll eventually even out.
you've got debt service commitments that you're going to continue to have out of that fund, but given our performance over the last few years, we're much more comfortable than where we were a few years ago back. So,
Right, okay.
That appears to be in a much better position now.
Okay.
I'll continue on pages 28 and 29. Well, really, let me point out first, 20 through 28 is some good information on the budget to actual for the general fund. And so on page 28, you'll be able to see that the net change in fund balance, again, the actual was a positive $3.8 million. That's a positive variance with budget of $5.3 million.
Say that again.
The change in the general fund balance was positive 3.8,
Yeah.
and then under the column that says variance,
Mm-hmm.
the variance between budget and actual was positive 5.3. So initially, the city had planned on a fund balance decrease of 1.5 million. The actual was a positive 3.8, so budget to actual was $5.3 million positive.
good.
On pages 33 and 34 are the financial statements of the pension fund, which is the fiduciary fund. You can see at the bottom of page 33, total investments and net position held in trust for pension benefits of $84.4 million. So those are all the investments that have been committed to pay pension benefits. And then on page 34, you can see the changes in those investments and the entire fund for the year. The very first line item, employer contributions of $14,009,000, included the $10 million, approximately $10 million that was funded through the issuance of pension bonds. And then under investment income, net appreciation in investments of $9.3 million due to favorable market conditions in the fiscal year. So in total, the net increase in your pension fund was $20,939,000 during the year. And that will go a long way to what your statement was earlier about, funding the pension obligations.
That's the contribution and the increase in the earnings.
Right. On page 35 starts the notes to the financial statements, and obviously I'm not going to go through these in detail, but there is a lot of good information in there about debt, capital assets, going back to the pension obligations. Really all the detail that supports the major numbers in the financial statements. And then on page 61, is some more information about the both the pension plan and the retiree health plan. And these two schedules show basically the funding progress toward those two obligations. And so the very first line item, fiscal year ended 6/30/14, you could see the funded status of the pension plan is now 95.2%. So you've got assets of 84.4. The actuary has determined your liability to be 88.7. And so the unfunded portion right now is almost 4.3 million. And that's the approximate number that will be recorded as a liability under those new accounting standards that I mentioned previously.
And how many years is it we have to get that evened out?
Well, actually,
Was it 15?
It's 18.
I thought it was 5 years, but it's,
No, there's 18, the most recent legislation gave cities 5 years to get their contribution up to the level it should be. But you've got as much as 20 years to correct for those unfunded liabilities. We've been in that for 2.5 years now.
we've been where we're supposed to be.
Well, we're chipping away at that
Okay,
unfunded
the
liability.
4-point-something million.
And you have made at or above the actuarial recommended contribution to your pension fund every year.
Yes.
So you're doing what the state legislation requires you to do. You've been doing it for years. In fact, the board has a number of times put in a higher amount than what has
It
been
actually
recommended to
shows
help
on-
support the
On
fund.
page 62, it shows it very clearly. Last year, you put in 300% of what was required because of the pension bonds.
Yeah.
But every year before that, you put in 105%, 102%,
Yeah.
104%. So it's been consistently contributing the right amount or more in order to bring this up to where it needs to be.
Yeah, I knew we were working on that, so that's.
Well, that's good. I can't help but think of Memphis. They said they're 200 million behind.
We're very fortunate.
We're 4.
Correct.
Some cities are having a deficit in their equity because of this. You're not. So,
Continuing on pages 76 and 77, that's where I'll go next. And these are the schedule of expenditures of federal and state awards. And so you can see there's a lot of detail on these two pages. But really, this is all the expenditures that the city has made under federal award programs and state award programs. So the city spent $1.1 million in federal dollars this year and about nearly $400,000 in state funds. We tested, if you look on page 76, in the second column that says CFDA number, the second line item down, it's CFDA 20.507.
Wait
It's
just a second,
got
I
the-
don't know where you are.
Right.
Oh, okay, 507, yeah.
Yeah, it's got the
Yeah, okay.
asterisk by
Asterisk
it,
beside,
which
okay.
means that's the program that we selected and tested as a major program this year. And then starting on page 85 is the statistical section in the report. And it provides data over the past 10 years. And a couple interesting facts are that the city's net position has increased by over $241 million in that 10-year time period. Sales taxes have increased nearly $7.5 million. The city's population has increased by about 43% in those 10 years. And also, one I always look at while we're doing the audit is that calls to the police and fire have gone up by about 46%. So that information is all within the next
Where are
20
you?
We're
pages.
just reading between.
You just,
Yeah.
you're reading, this, what you're saying is
I'm
not in.
just summarizing
It's in there.
what's in there.
It's in-
Yes,
it's
it's
in
all
there.
in
It's on
there.
different
Spread it on
pages.
the next 10
Yeah.
pages.
Yeah, you got
Yeah,
10
so-
pages of history and
Yeah.
trends.
Okay.
You're just picking the highlights of the 10 pages.
Too much to go
We're
over.
trying
but
to
I've-
find it.
Repeat what you just said.
Good bedtime
Yeah,
read.
Yeah,
repeat what you
repeat,
just said.
yeah.
We was busy looking for the.
Yeah, well, the population of this, of the city has grown by 43%
43%.
in that 10-year period. And then calls to police and fire, the number of calls received has increased by 46%
That's page 103.
Okay.
in that time period.
So more people, more police calls.
And then the final section of the report is the compliance section, which starts on page 105. And there are two other independent auditors' reports that we issue in accordance with government auditing standards and then also under OMB Circular A133 to describe our federal program testing. And then on page 110, there is one finding to go over this year, and it is reported as material noncompliance with laws and regulations, and then as a significant deficiency in internal control. The item's previously been communicated to you, so you know about it,
Yes.
relating to the noncompliant deposits. So, of course, State of Tennessee requires that public funds be deposited within 3 working days. And during the fiscal year 2014, the city identified certain deposits that had not been deposited. And so they brought it to our attention, conducted an internal investigation, which was just completed, and I think you want to address that. But from an audit and internal control perspective, we believe that this is a situation that can be used constructively to encourage employees to bring up these any problems with internal control or policies and procedures as they're happening. And so that's really the takeaway from an
It's a
audit
good thing.
perspective,
It's a good thing.
is to, strengthen and encourage employee communication. So I think you want to address.
I'll just comment briefly. It is an issue that was identified during the year. It isolated really to a single employee where some checks were received to pay multiple fees associated with development. We were just implementing a new system, new software system, so the combination of how to allocate those funds among the various appropriate fees and the newness of the system and uncertainty around it, we had an employee set those checks aside to be worked on later to figure that out. And what came of that was that we did not get the money deposited within the 3 days that we were required, within which we were required to make those deposits. So that was identified by our own folks internally. Part of the separations of duties that we have and what we do in the city helped identify that. Was immediately brought to my attention, brought to the auditor's attention. We conducted a full review. The involved employee was subject to discipline. We did have further review to make sure there was no other activity. I made a report to the sheriff's office to have them look to make sure too that there wouldn't be any consideration of any criminal activity, all of which was found to not be the case. It was just someone making a mistake, not following through on the proper procedure in terms of making those deposits. Everything is balanced out over time. We did a multiple month report to make sure that we were reviewing all of our transactions and there weren't any deeper systemic problems. It's really a relatively small number of transactions and no out of balance, no misconduct except for the error in not following through and making the deposits in a timely manner. We have now established a process that checks this on a daily basis, rotates those duties during the day, feel that we have a very strong procedure in place so that this will not happen again. Our familiarity and comfort with the new software system has improved over time as well. So all of those put us in a much better place. We regret that the mistake happened, but we also, that does happen from time to time, and what is important is how you find it, identify, fix it, and learn from it. And we feel we've done that.
Absolutely.
Any other questions on either the city audit results or the CAFR before we move to the conference center?
You're doing well. Let's keep on keeping on.
All right, well, I'll go next to the report on the 2014 audit results for the conference center. And this communication is very similar to the one we went through for the city, so I'll just hit the highlights. Again, on page 2, we have completed the audit, and we drafted an unmodified opinion stating that those financial statements are fairly presented in all material respects. Again, we confirm our independence. On page 3, management has made judgments and accounting estimates with respect to, again, the useful life of capital assets, and then the appropriateness of the assumptions and the calculations made for the allocation of joint cost at the conference center and hotel. On page 4, audit adjustments. During the course of the audit, we did propose one significant audit adjustment which related to annual depreciation expense. The conference center does not track depreciation expense on a monthly basis throughout the year, and that's usually left to a year-end activity. And so this entry is similar to ones we've booked in the past or proposed in the past, and management has recorded it within the financial statements. On page 5, again, we had no disagreements with management, encountered no significant difficulties, and did not identify any fraudulent or illegal activities. On page 6 are the areas of audit emphasis. You can see listed there cash, including classification between restricted and unrestricted. The conference center does have a requirement to put aside 4% of its revenues into a restricted cash account to be used for future capital improvements. And that account has grown significantly over the past few years. As you'll see, it's in the financial statements, it's now more than $800,000 to be used for capital improvements over the next year. Additionally, we looked at classification of net position. We tested operating revenues And then, of course, again, other operating expenses, including those allocation of joint costs.
I have a question, Dan.
Mhm.
The 4% that they put aside, is that a year or a month or a day or what?
I believe they're putting it aside each month.
Okay.
And who was the management team that you dealt with over there?
During the audit, it
Yeah.
was Noble Interstate, which
It was
was,
the old
Yes.
manager.
Right,
Prior.
because I know that it newly acquired, so I'm just wondering.
yes. They were there for the entire fiscal year, and then for, I think, a month, just about a month after year end. Yes. And then again, as included as Appendix A, we've put the representation letter in there, again, so you can see the types of information that we're asking for during the audit.
Okay.
Well, move it.
All right, and then if it's okay, I'll point out just a few things in the conference center financials quickly. Again, on pages 2, 3, and 4 is the independent auditor's report, and it is an unmodified opinion. Management's discussion and analysis of the current year operations in comparison to the 2 previous fiscal years. That's included on pages 5 through 10. And then on pages 11 and 12 are the basic financial statements. You can see on page 11, which is the statement of net position, under current assets, the cash that we were just talking about restricted for equipment replacement of $812,000. And then the remaining operating cash of about $71,000, which was consistent with the prior year amount.
Say that one more time, what you just said.
Under current assets, the cash.
Yeah.
You see restricted for equipment replacement. That's that 4% reserve
Okay,
that will be used for capital improvements,
okay.
most of which are planned for fiscal 15.
And then the other?
And then the unrestricted cash, which is the operating cash,
Oh, okay, I got you.
71,000
All right.
versus about 63,000 last year.
And what did they do with that?
That's for ongoing operations,
Working capital.
working capital. And then the statement of revenue, expenses, and changes in net position is on page 12. You can see that under operating revenue, banquet and catering was nearly was about 6.3 million in 2014 versus 6.7 last year. That's about a 6% decrease. There was about 215 fewer events in fiscal 14 than 13.
That's interesting.
And that's due, again, to the competition that has come into the area. Total operating expenses were about 6.5 million in each year. They were down slightly by just about 1%, less than 1%. Within those, the most significant one to point out is sales and marketing. You can see that has increased actually significantly over last year. And that's the effort
Yeah.
to offset that competition that's come in. So the operating loss this year, 156,000 versus an income last year of 208. So that a few line items down from that, net distributions to local governments. The net distributions were 194 this year versus 492 last year.
Wow.
You feel that?
Oh, that was a loss last year.
Yeah.
Oh, okay.
Remember, though, that that's not a cash loss. I mean, that's a loss
On the,
after you've taken the 4% out. If if we weren't withholding money for future capital expenses, they would have just barely broken
Are
even.
we holding it or are they holding
Well,
it?
they're holding it in a insured account.
Okay.
The notes start on page 14, again with the summary of significant accounting policies, which tells, again, the reader how the conference center is accounting for its financial transactions through the year. And then on page 18 and 19 are two significant notes, and I think I point these out every year, but the one is, note D on page 18 is contractual commitments, and it tells you about the franchise agreement, the operating agreement, and the catering agreement between the city, the county, and the hotel operator, and the fees that are being incurred by the conference center under those agreements each year. And then on page 19, related party transactions, this note describes those allocations of the joint cost between the hotel and the conference center, again, under the agreement.
when is our 25 years up?
Well, we just renewed for another 15.
Oh, okay. Don't even
Couple years
think they're, don't even go there. All right.
Maybe one thing worth mentioning is we've got a meeting, the county, my counterpart at the county and I are going to meet with them on Monday with the new management. You know, they've had their shakedown cruise now, so they really started the end of July. So they've had about 3 months to operate, and we're going to go in and talk with them about how they feel about it, what they're doing to correct this trend. So we'll come back in January and report to you on that.
And I might have a few things to add to your remarks to them.
Something about food?
Yeah. And service.
Okay.
Does the county own this now still? I mean, are they still getting half of it?
Yes, they do.
We're both from the same
It's
city.
50-50.
Is it always going to be that way?
Until something changes.
Someone wants to-
Okay.
That's the arrangement.
Somehow I thought, once they were, you know, that all of this was over in 2014, something happened in
We
2014.
retired the debt a couple
We
years ago.
finished paying for the
Yeah.
construction.
Okay, so, but the agreement, the partnership still holds.
Yeah, that's the financing. We own it. We paid off our mortgage, but we still own our portion of the conference center. They still have an outstanding debt to pay their half of the
You mean the
conference.
county?
County does, yeah.
Oh,
Yeah.
okay.
But we still are in the same ownership position.
Okay.
What has changed over the last couple of years is we retired our debt. We finished paying that debt off on the city side.
That's what I
But the
didn't really.
50/50 arrangement that has been in place since inception remains.
Okay, thank you.
I think that concludes what we had prepared to talk about. Let's if there's other
Lovely.
questions.
Lovely.
I'd like to thank Dan and his team. He has an excellent team that he brings in. They're very efficient, they're very thoughtful and easy to work with. You know, they tell us what they need. We sit them down in front of a computer and they go digging through all of our records, our millions of pages of records. But it's been a joy to work with them over these last 4 years.
Thank you. Same for us. I mean, like I said at the beginning, we really appreciate the preparation and the time that goes in by the finance team ahead of time so that they're ready when we get here and they
I'm
make
sure
it,
that's a help.
they make it efficient for us.
They don't put all the bills in a shoebox and hand it to you.
No.
We thought about it.
Unfortunately, Mike Lowe, our comptroller, is not here tonight. Mike works exhaustively with the auditors as well in terms of leading what we do from the finance side, and just want to recognize his fine work in doing all that too. So.
Well, we're very blessed with our staff and to have you all, and we really appreciate it. Thank you. If you
Thank
make me
you.
understand it, anybody can understand it.
You're doing okay.
Thank you.
Thank you so much.
Thank you.
Appreciate it.
Eric, I'm not sure if there's anything else that we can
Well, we
do.
can talk about items, you just can't vote on them. A number of these we are advancing to the board anyway,
Yeah.
that we'll be able to talk about. The next one in terms of the debt policy, we're having some further discussion at work session anyway. So if you want to talk about it, we can talk about it. We have some other members present, but you're not going to be able to vote because you don't have a quorum. So
Well,
we'll leave it up to you if you want to walk through the rest of the agenda, and we can touch on those items. And I don't know if there's anything we absolutely needed action on from this group tonight.
I don't think so.
We may have, anything from the agenda, Linnea, that you think?
Number 4.
We may have to pull them out for
Yeah,
a
I
vote.
I was gonna say,
I'm gonna
because
talk about
we may give you a
something.
little something by listening.
Yeah.
A little bit. What do you all think? By listening, giving a little bit of the information now.
I have a question.
Yes.
But-
You will. Item 4 is an action we will ask you to vote on the 9th if we can. It relates to just starting the process for the 2015 bond issue, which we had anticipated in our capital program that we would issue debt in 15. The market continues to be really strong, positive for us, and with actually not a lot of competition out there. So we think we could fare very well in terms of interest rate if we are, get out there at a decent time. But we want to start the process so that we can be ready to time that when it makes sense. So this would just start that process in terms of notice and kind of declare our intent. And there's a public notice timing and process that
Well, can't we
that
go
goes
on
forward.
and, can't you go on and do that before the
We need
board?
you to approve us to do that on the 9th.
On the 9th.
You need to say, start it. You're not approving the bond issue yet,
Yeah.
you're just
Okay. Well, we
expressing an
started.
intent and starting a public process.
But you don't need us to do anything.
I need you to vote on the 9th,
Tonight?
the 9th,
December 9th.
Tuesday.
Okay.
So, but we wanted to run it through the committee before we brought it there. Russ can talk a little bit about it, but it is on there. That's the only thing you're going to vote on, I think, that's on this list. Everything else is more informational.
Well, if we can spend
So-
just a little bit of time with Russ talking a little bit about that, and the rest of the stuff, we can, agenda items, we can just refer to the 9th
I have a couple of questions
on,
on item 3.
oh, okay. Well, let's just go ahead and go through a few of them. I should say. Item 3, the consideration of resolution 2014-82, adopt a revised debt management policy. Talk about that
Yes.
a little bit.
It was almost exactly 5 years ago when we adopted the debt policy that we have now, and part of that said that of that policy dictated that we'd come back in 5 years and look at it again and see if we need to make any modifications. So the time is nigh. It's time for us to take a look at that. And the most critical part of that are the ratios that we have borrowed from our friends at the rating agencies, Standard & Poor's and Moody's. One thing unique about our debt policy is we've tried to put ourselves in the position of the rating agencies and say, what would a AAA city look like? And instead of setting a debt limit of just a hard number that you pick out of the air, we've set these ratios that rating agencies rely upon. And they're involved, what budget resources that you have, the wealth and the income of the community, how large is your property tax base. They're all spelled out in Section 5 of that debt policy. But in order to make those modifications, the first thing that we need to do is to go back and take a look again at updated medians that the rating agencies provide us. But we also took a look at other cities that we thought were very much like us. And they included, Alpharetta, Georgia, and Naperville, Illinois, and Chattanooga, and Germantown, and Brentwood. A lot of those cities have changed, as have we. Our financial position has actually gotten stronger relative to where we were 5 years ago. Some of the other cities have not fared that well. And what we'd like to do is to get your opinion of whether we need to continue looking at those cities to help us set our parameters, our goals as far as what we want to have on our ratios, or whether we want to look at some new cities. That was the piece that we handed out at the work session last time.
And we didn't have a lot of time, so that's why we scheduled it again for the 9th.
Right.
So,
So what the purpose of putting this item on there is, at some point next year, we need to pass a resolution updating the debt policy. But the first step along the way is to identify the cities that we want to compare. So we're not asking you to figure out which ones are the perfect cities, but we'd like for you to look at that list that was provided to us by our financial advisor, PFM. You know, they've selected 8 or 10 cities. They're not the same 8 or 10 cities that we had last time. So we'd like for you to look at those if possible and see if you feel good about them. If you feel strongly about telling us to keep the Brentwoods and the Germantowns in the mix, then we'd like for you to tell us to do that. I think that's what PFM would recommend anyway,
That we would keep
that we
them.
would keep those in. But if there are any other cities, you've made a field trip to Carmel, Indiana.
Well, that's in here.
Well,
Well, not
there,
on that list.
we have suggested to PFM
It's
that
not
Carmel,
Well, it's in there.
we have suggested that Carmel be added, but it's not a AAA city. It has some very different demographics than some of the other cities that we do have on the list. So if Carmel or Cary, North Carolina, or, you know, a suburb of Kansas City or Omaha or anywhere jumps to mind that you would like to see us consider, then we'd like to know that, so that over the holidays, PFM can go in and start doing the digging that's necessary. If you look at the list that they've provided us, they've just picked up the database from Moody's, the rating agencies. And you can tell by looking at it, there's some incorrect data in there. You know, you can look down the list and everybody's got $1 or $2 tax rate, and then you hit one that's $9. Well, you know, I'm pretty sure that's incorrect, or there's something unusual to do. The 8 or 10 cities that we end up with will require some detailed research before we come back to you and say, well, these are the numbers that we've actually put together. So we're fishing, we're looking for your advice and your input to share with PFM so that they can make a recommendation on what cities we include in this, in the research we're going to do.
Just looking, some of those home prices does not match.
Doesn't match at
ours,
all.
So
That's right.
that would be definitely a reason for me to want to add some additional cities
Well, how would you do that?
by this, by looking at.
Yeah, there's a table in there that gives you
Yeah,
some
well, I
cities.
see the table.
Mhm.
So if there's if there's a city in there that you're familiar with, you know, I would ask you to tell us about that and what you know about that city, so we can share it with our advisor and let them add that to the list, or do a little research to see if it really should be included or not.
what we're trying to get at is that the AAA rating is extremely important. So we want to stay focused on that. But we also recognize we are a city with significant growth pressures. And not all AAAs have significant growth pressures. A lot of them skew towards cities that are built out, and there's a high stability level that lends to that AAA rating. We have financial stability, but we are a dynamic community with a lot of growth. So we want to look at communities that have that high financial standard, but may also be facing some of the same growth pressures that we are.
How do we know that?
See, that-
Well, by understanding the community profile.
Yeah.
And that's what some of this information may help you understand. Some of it is just things you may know about a community as well. There's some objective material and there's some subjective material to all of this. And so we're just trying to cast the net wide enough that we get a good sample. I think the preponderance needs to be AAA cities, but there might be some highly rated AA cities that are growth cities that might make sense to incorporate as well. Just to make sure we're getting a good picture here. So that's what we tried to lay out. That's the sort of the guidance and discussion with PFM to date. But we want to make sure you're comfortable with the composition, and if there's other things you think about that we may be missing along the way, let us know, and we'll try to make sure that we've got a good reflective group in terms of the kind of high quality, high credit, financially strong communities that may be facing some of the same challenges we are.
There's several here from Washington.
Well, I was going to say,
That's some Seattle area.
one of the things,
Bellevue.
I put those in because I'm familiar, have family out there. But I thought Redmond, Washington would be a slam dunk. But if you go through and you look at it, they have 25 or 30% of their property tax comes from one company. You know, we want a city that's more diverse than that. So we've scratched them. But that's the thought process we want to go through. If there's some, something that, a city that lights you up, we'd like to go through and look at it and see if there are any disqualifiers in their profile.
I do think continuing to have Brentwood and Germantown just makes sense because there are other Tennessee cities. They're not exactly like us, but they face the same environment in terms of the state and some of the issues and guidance we have to work through. So I think that makes sense as a baseline, but we want to round it out with other cities that fit our profile as closely as we can throughout this. So you got a lot of options here, but there may be others, and there may be things you may not be as comfortable with in terms of the list we've provided you. So it's a work in progress, and take some time to look at it between now, and we'll talk again on Tuesday night.
If you go through all these, I don't see there's any way that I personally would look at all this stuff. Even from, 2 weeks ago, since we had Thanksgiving in between, and some of these numbers, where we're talking about the percent change in population, says Franklin had 1% and Brentwood had 5% from 2010 to 2012. I just wonder if some of the numbers.
Well,
That's not accurate.
that's really the issue. This comes from a Moody's database. We don't trust that database.
Okay.
So what we want to do is pick 8 or 10 cities and say, PFM, go get the audit reports and tell us what the real numbers are. That's why we can't go do this whole exhaustive list. We're going to have to pick and choose to be able to do the depth of research that we need to have confidence in the numbers.
Yeah, there'll be more work that goes on, but we need a starting point of what cities we want to hone in on and do that work. We can't do it on everybody on the list.
But we'd like to not do this every year. We'd like to have this hold up for 5 years. So the quality of the data and the quality of the selection is important because it needs to last us for a while.
Dan, can y'all help
Let me
us
ask you one question about timing.
with cities?
If we get this, if we do something, decide something by December the 9th, how much are they gonna do over the holiday season? I mean,
Well, our goal would be to have something in place that you can make some decisions on this probably in March about the debt policy.
But could we have a little time to look at it?
Oh, absolutely.
It's just the timing of it is what I'm trying to say. In between last meeting and one next week, there's been the Thanksgiving holiday, and then, after that.
Well, we just got our audit report tonight.
Yeah.
And other cities over the next several weeks will be getting theirs too. What we would like to do is to turn PFM loose as early in January as possible to start looking at these and collecting these and going through them. So if we know Germantown and Brentwood and we're going to keep them, we can get them started.
So, yeah, it might be a thought of what are the ones that definitely make sense. Maybe there's a group of 6, 7 that makes sense. We can start on that. And then maybe there's a group we're not sure about. Let's look at them a little more. And we could layer those on maybe later. But let's start the process.
You're right, some of them you just X out because of some of the things that you were just talking about.
We want the best fit we can find.
Is Cary, North Carolina still?
Yeah, but they're getting awfully big. And that may be,
They have grown.
They've got some similarities and they're AAA.
yeah,
I would think you'd want them on there.
I would think you'd want them
Even though
on
their size
there.
is bigger, they're where we're going to be
They're the
in
growth.
15,
Right,
20 years.
right. And we
So-
need a combination. We need some that are probably smaller and AA and growing, and some that are bigger and AAA and are already there. Getting that mixture, we can throw out the high and the low and come up with an average and say,
Yeah.
this is kind of where we want to be.
Okay, and what are we going to do with this information?
We're
Exactly.
going to set the parameters for our debt capacity model. So when you decide on your capital project priorities, we can go down and say, this is how much money we
Remember, we've
have.
got all those benchmarks that back up different elements of your policy. This would refresh that with the data we get from these cities and
With current
what's
data.
being reported through the bond rating agencies. Because we're trying to look at our community in the same way the rating agencies do. We're trying to approximate that.
You're really rating yourself.
Yeah. we
Exactly.
really are.
Yeah.
Yeah,
And really,
Which is
those
smart.
things that you had on there, I think were like, what, 8 years old, maybe you're 6 years old at least, 6 years old.
Yeah, to be at least 6 years
Yeah,
old,
at
because
least 6
we
years
did it
old.
5 years, and they're probably 6 or 7 years old.
that's exactly right.
So, yes, I thought that was good.
Now, we have refreshed some of the data along the way, but
We
the
have,
sample group is,
still the same.
yeah, dates back to that.
So that's the reason we wanted to get this in front of you. Start thinking about that, and, you know, if you have an interest in the city and you want us to include it, we're probably going to turn PFM loose on some of the cities that are obvious in their proposed selections, and let them go ahead and start retrieving the documentation they need.
If you want, on Tuesday night, we can kind of give you what our thought is about what the obvious cities are, so we can at least get
I'd
that
like
done.
that. I would
And then
very
if
much
there's some
like
others you want us to
'Cause you
look a
know
little
what
more
you're-
at, or just give us some general feedback on, like, you know, I don't buy it, or, yeah, definitely, let's look at this more, that's great too, and we'll keep working it.
Are we limited to 10 or whatever?
No, but
I mean,
you can have 12.
well, no, I'm just, you know,
There's
you're
just-
coming with great, 10 great ones, and someone else wants from the
I don't think we need 20.
Okay, all right.
You know,
Yeah,
there's
that's
a,
true.
It's got to be work manageable.
Yeah.
I got it. All right, I think we should be able to have a lively discussion on Tuesday. Anything else, Eric?
well, item 4 is again, the initial bond resolution. It takes 2 resolutions to issue bonds in Tennessee. You have to basically declare your intent and run a notice in the newspaper, and that's what we're asking you to do. The 15, up to 15 million, we don't know if it'll be exactly 15 million. It'll depend on conditions when we get there. It'll take at least 60 to 90 days for this to go through and get a second resolution done and make a decision and see when we can sell the bonds. That's why we want to get an early start. But this is the first step, and if you can go ahead and pass this on Tuesday night, it will help us. And this is the money that we have already built into the debt capacity model. We anticipated doing this year and another 15 million in 2017. And this is for the projects, many of which are already underway.
And how much is it?
Well, I listed up to 15 million.
Okay.
All right, let's see, Adam, 5, item 5, consideration approval of resolution number 2014-90 to revise section E of the purchasing policy for the city of Franklin, procurement not pertaining to new construction. Any conversation on that we can glean at this?
5, 6, and 7 are items we've been working on for a while. We brought to the committee about debarment and how we work with vendors and kind of updating and providing more structure to that and having an appropriate level of accountability for the outside services we use and how it might affect our ongoing business relationships with some of those entities. So Brian's done a lot of work on it.
I would really like to hear what he has to say.
So I don't know if you want to give an overview. I kind of feel like we'll be bringing this back in January for a more complete discussion with the whole committee.
Is this what we've been talking
Yeah,
about?
this is some of the stuff related to, you know, we need to have a clearer policy and procedure on.
And I feel like it's been a while. I
Brian,
think
can
we
you just
need
give
this.
us a couple high points, if you don't mind? And we will be back in January with this.
And we actually meet in January on, what, the 8th or 9th? 8th? So you'll have that meeting before your BOMA on the
Oh, okay,
13th, so we can keep
Okay,
things
well,
moving.
Are you okay with him not?
I just want to be sure we're working on it.
We got Brian here, and he's all dressed up nice.
I know.
I know, he looks so nice. I hate not to perform.
He looks nice every day, though, I have to say.
So is this something we need in our repertoire to have, in your opinion?
It is. I often think of purchasing methods as options, tools in a toolkit or toolbox, and the debarment and suspension is another tool in the toolbox.
Okay.
I personally hope we rarely, maybe even never use it.
Yeah.
But having it in the toolbox, I think, sends the right message that we're serious about wanting an excellent working relationship with the vendor community, as
Exactly.
Mr. Stuckey was saying earlier. There are 3 items on your agenda that have my name on them. They're really 2 topics. The first one is having to do with the purchasing policy, and I'd be glad to talk a little bit about it. And the other has to do with the debarment and suspension. The reason there are 2 agenda items on that is one's an ordinance that establishes a policy and one's a resolution that establishes a procedure, but they're really on the same subject. So there aren't 3 separate topics. None of those topics are particularly time sensitive, so it'd be fine if you want to hold off until next month, or I'd be glad to take you through what I've prepared if you'd
No, I
like.
think you have given
No,
us enough.
yeah, I think, we know you're working on it, and you know that's what we want, because we've, I think, made that clear.
Yes.
And Brian's been working closely with the law department, because so much of this has
Yeah.
significant legal implications. So this has been well vetted by him and our attorneys. So
That's good.
I think it's ready for you to give feedback on and for us to take action on once we've done that, so.
I'm looking forward to it.
Okay.
I'm too.
All right.
Thank you,
You're welcome.
thank you.
Item A, I mean, we can't do nothing regarding a budget amendment here.
You can't. I think it is on the Tuesday under new business.
Okay.
It's a routine second quarter budget amendment.
Yeah,
Now we-
there's nothing extraordinary
Okay.
in that.
And item 9 is consideration of resolution 2014-91, a resolution to authorize capital improvement at Goose Spring Conference Centers. So since we just talked a little bit about that.
Well, we know they have $800,000 to do
Yeah,
it.
well, exactly, and that's why we went ahead and put it, we're a little premature, but we wanted to put it on this agenda.
Uh-huh.
We do have this balance. It is time to refurb the conference center. You know, in my limited talks with the new management, you know, they think it's not really holding us back, and it's not helping us either, because, you know, things do get a little worn down. They are going to completely refurb the hotel at their expense, including the lobby. So if we don't refurb the conference center part, we're not going to look very well coordinated. But what, we have not drafted the resolution yet, but we would like to go ahead and do that, giving Eric the authority to approve these requests as they come through, because they'll come in and nickel and dime us on these requests. You know, they'll do the tables one time and the carpet one time and the
Yeah.
wall covering another time, and, you know, the timing will be way off, and we don't want to bring 200 items to the board to do
Yeah, there's a
that.
broader capital plan that they're gonna be working, and they've got these first couple elements, but we know there's gonna be more to come. So if we could get some just sort of global authority to work within the budget that's been established, that sort of thing, to help them do what they need to do, that's what those dollars are set aside for.
Yeah.
And there is sort of a required refreshing of the property that comes with this sale and them remaining in good standing with the Marriott and all that kind of stuff. So there's things they have to do on the business side and things that make sense to do for the conference center on a regular basis anyway. So those kind of sync up
They do.
in this process here.
Okay. I guess everything else can wait.
There's nothing spectacular in the monthly
Highlight,
reports, but I would, again, urge everyone, if they're reading along at home with us, to, you know, those reports of our major revenues are posted with the agenda for these meetings, so they're worth looking at if you have an interest of how we're doing at the conference center or at the on construction activity or sales tax, property tax, et cetera.
About $380 million of investment through the permitting process in the first 10 months of 2014.
Yep.
So pretty significant activity, and it's
That shows that growth.
only picking up the pace. So just, it's reflected in our permits, but that's the kind of
About how
investment we're
much
seeing.
more is that than it was last year?
I don't know the exact numbers, but
I couldn't tell
it's
you.
higher.
But it's higher.
It's significantly higher.
A lot of it did occur in the first 6 months. So we actually, the last month was actually down a little, if we assume the same seasonality as last year. The problem with so many of those things is you can't assume a seasonality, because if you had a big project come in September last year, and
And we've got some
the
big
big one this
projects.
year comes in October,
Yeah.
the months look completely out of whack. So you really have to look at it over a longer period of time.
Fuel, hedging, I mean, fuel is down, but we are hedged,
Well,
so.
I promised someone I would say this tonight. Yeehaw, we lost money. That's a good thing, because for every $30 we lose on the fuel hedge, we picked up $100 at the pump. So-
Walmart.
So when our fire trucks and our police cars go to the pump, we're paying far less than we were, at least $1 less than we were this time last year. But we are underwater on the fuel hedge because of that. We locked in the wholesale price of gas at about $2.65, and the price last week was $2.05. That's how far it's
We
fallen
made
at
that
the wholesale
decision. It
level.
was.
Yeah.
Well, we're protecting ourselves on the
It balances.
other end of it, and there've been a number of years where that's helped us a good bit. But at the end of the day, we're still doing better than what we had anticipated budgetarily, so you
Well-
take that.
I think I asked you this question last year, and I'll ask you again this year. How are we doing?
That's another good question. From an audit perspective, I think you're doing well. You know, we had the one finding,
Yeah,
which
we know all
was brought
about
to our attention, you know. But from you know, obviously the numbers are in good shape. We didn't have any other material weaknesses or significant, you know, matters to identify to you as a result of the audit. You've got a clean audit opinion.
We know you look at a lot of cities, and I guess what we was trying to get
Mhm.
was that, you know, we need you to say that we're doing better than.
I-
a lot
I-
of cities.
Yeah,
And particularly, like we said before,
You're doing very well.
we,
Just say, as an economist, I think, because they're never right anyway.
no, I think we can say with confidence about your pension plan that you're doing better than a lot of
Far
cities.
well, we like to hear that.
Yeah.
But also, we want to hear, and our citizens want to hear, that we're in good shape financially.
Yes.
Yes. And all of these plans are very innovative and good.
So you can give us all of this, and it's great, but I just like to hear you say in plain
Yes.
language, you're doing fine.
You're doing fine.
Great.
And I think, you know, Russ provided the Moody's report for the last rating action, and that summarizes very well your financial position. So if you want to know the answer to that question, I'd read this financial statement, and particularly management's discussion analysis, but I'd read that Moody's report as well, because they take this and dissect it, compare it to other cities,
Yeah.
and so that gives you a really good picture of it.
That's good. Thank you. We
They
appreciate
do
you
look at
being
it
here.
from, you know, an economic standpoint too, about the tax base that you have here, the
The lo-
corporations.
Yeah,
the
local vitality,
individuals.
economic strength, yeah.
All
Very
right.
good.
Eric, I think something exciting going to happen this evening.
We're gonna light a tree at
Yes, we
7.
are.
You want to let everybody out there in TV land?
It'll be an exciting event. We've upped the bar on the event, and hopefully the weather's cooperating with us. But we're gonna light up the whole square, lots of fun things that way. We'll have a couple choirs performing. We'll have carolers, we'll have some food. The whole square is gonna light up though, like it's never lit up before. And then we'll light that tree, and it'll be a great time.
Great, so come on out,
That's
folks.
exciting.
All righty, anything else?
No, you've done well.
Well, we are going
You've
to
done
go ahead and
well.
adjourn this gathering.
Thank you very much.
That's good, thank you.
Thank you.